I haven't had a chance to upload the executive summary yet, so I'm going to record this total session and then upload it immediately following. So this is the weekend Tortoise report review for June 27th report 2015. Markets in bullish normal conditions. Using the weekly RSI 14 on an annual basis, the market is in neutral at 56 out of 100. On a 10-day basis, we're right in the middle at 52 out of 100. That's using the 10-day NDX. Looking at the market mosaic, price with respect to the 200-day moving average is yellow bullish at 3.11%. So only 1.1% cushion to sideways markets. ADX is a very weak or untrending at 14.9 on the classic ADX. The Risc Index is the 30-period moving average of the VIX divided by the 10-period. Right now that works out to 0.999 or just barely risk off. If we take that score, look back 5,000 trading days and find the average and the standard deviation of that indicator, it comes in with a Z-score, or what we call the risk Z, at a reading of minus 0.08. This shows a histogram of that indicator for the last 90 days. You can see that we're almost back into the to the green here. We've had a set of rising inflections. I treat that as very favorable. When it crosses into the green line, we are definitely into zone 2 on this indicator, which is favorable for swing trading. So I take that as a positive sign. The fact that it could only get to minus 0.5 on the last little bit of pullbacks here. No change in monthly rebalancing. We'll be adjusting that portfolio set this week. These are the readings right now that we're holding. And then under the current leaders, you can see the winners as of Friday's close of business report. Japan remains remarkably strong, and healthcare inside the ETF 22 and 32. ETF 2 remains at 70% in the theoretical model. The model portfolio will be at 90% exposed with the stops in place. This is some alpha statistics. So we get this by computing the 30-period regression line slope of each of these indexes, subtracting out that of SPY, and then finding the standard deviation of it compared to its historical norms. So that means that the zero line is really the performance of SPY. So you can see oil has been improving and is slightly better than the US S&P. Technology has pulled down to a weak minus 1.5. Mid caps are also weak, as have been the small caps. So what we're seeing right now is a recovery in the US large caps at the expense of those more aggressive indexes. So you got the diamonds make a double bottom are moving up. Japan is still strong. I just would bring your attention to Latin America and emerging markets are both very strong right now. So this may be a rotation back towards the neglected large caps. That's the way I'm playing it. Next up is a review of some of the blended monthly rebalancing portfolios. You can see they're about the ETF 13 and 32 are about equally split on buy signals versus cash. The winners in the ETF 13, Japan, US small caps, tech, globals, with most of the smaller or riskier or alternate asset classes being on cash positions. So that's Australia, which is strongly commodity based, real estate, treasuries. In the ETF 32, interestingly, FXI China has been so strong for so long it remains near the top on the blended basis, but you can see that it's been going through significant pullbacks. Consumer discretionary immediately comes to my attention, being greens across the board and in position 4. Small caps doing pretty well also. Among the ETF Max candidates, these are looking at the database of 1,100 ETFs and sorting by the blended number. Big pullback across the board in all things China. Even the S&P Biotech's pulled back, so there may be some buy on dip opportunities there. If you're looking for straight strength, it's cocoa, chocolate, regional banks at position 11, U.S. healthcare at position 13, more regional banks at 17, cotton at 21, more banks at 20. So this is evidence of some of the smaller banking sectors showing some strength. And when we look at the Dow, we'll see Goldman Sachs really leading the way there as well. So I'm seeing that as an emerging trend. In the S&P 500, looking at the individual stocks of that component index using the same lens. These in the top position: Cigna, Cablevision, Hasbro, Aetna, and Electronic Arts, all greens across the board, showing current strength. Universal Health Services, UHS, is certainly one to take a look at as well, in position 11, and ConAgra in position 12. That's a third week in a row that's been very strong. The fact that it's only white on the 12 or on the 6-month look back suggests there may be some more room in ConAgra. So I definitely want to look at CAG. Just making some notes here on some symbols I want to look at. Hasbro and Aetna and ConAgra. I also like Lilly down here in position 30. We've been having some good fortune trading that one. So Lilly and Humana, LLY and HUM. Now we'll take a look at the market health check. So the vertical blue lines are 10, 20, and 30 days worth of look back. The thick blue lines are that 30, 60, 90 look back. The purple line is at the swing, that's the price target at the recent swing high at 213, which was rejected on this last little bump. And we have pulled back just around 210 to the middle of the river and holding in the bottom end of the dragon right here. So what I show on the right hand side in the blue shaded from like 213 down to 203 is just about a 5% sell-off from the swing high. So as long as we're in this blue shaded area, we're still in noise in terms of institutional money's posture. It's interesting that it's a 5% sell-off from the swing high down to the 200, and we're still in about the upper third of that. So this is still in the noise range, and the market is trending slightly grindingly up, as you'll notice from the slope of the river. Has been basically up, although very, very choppy. You see the 10-period regression channel sloping up, the 30 channel sloping down. Looking for it to hold support here above this 209 area and then go test 213. It has to break above 213, clear that, and hold to be convincing about the return of the bull. You can see we've been flirting back and forth between overbought, oversold, overbought. So that's been a reliable indicator as far as playing these swings, but when to be buying, when to be selling. We would like to be buying below that 30-period mean, and then selling somewhere north of that, so that we're buying in the value zone, selling in the opportunity zone or the profit zone. But it's definitely been a grinding kind of a market. Notice the slope of the 30 is still negative. Down here with the red dot, it's at a reading of about minus 0.06. Still not surprisingly or abnormally steep down. So that's what we're tracking here. The green and the red are showing the extremes on the swings of that slope reading, and then the blue dots are where it's crossed the zero line. Next up, the ETF2 regional report. Still 3 of the 10 on cash signals. So that leaves us at 70% invested, 30% in cash in the theoretical model. The globals, EFA, at a score of 44, are still stronger than the S&P at 40. So right now, global still stronger than the S&P. Inside the U.S., it's the small caps at 45, then tech at 44, mid caps 41, large caps 40. Two strongest sectors are Japan at 49 and Europe at 45. The two weakest sectors are Asia less Japan at 33 and then EEM at 39. Weakness in the sector spiders, the only two really showing any strength, XLV, XLY. That's where I think the safer money is, especially XLV. Notice it's got green on the average and been very strong on a quality basis as well. So we're going to go take a look at XLV, XLY when we look at charts. Next up, market health check. The U.S. is all above average now. You notice the Dow has pulled back up into above average, so it's been stealthily improving, as we saw from the alpha chart. All of Europe is above average. Strength in Belgium, Netherlands, Austria. We'll see what the effect of Greek news has on that. In Asia, it's China and Hong Kong. Latin American emerging markets have been stealthily getting better, as has Brazil. Oil's had a nice bounce, as has private equity, but still seeing a lot of lagging in the alternate investments, like in the fixed income, treasuries, and real estate. The ETF 30, using that ETF2 lens, biotech, regional banking, and then 3 that have really improved here. They're the green and the white. AT&T, oil, it's had a nice bounce. That helps explain the Russia move as well. Belgium and Netherlands. But really, to me, it's biotech and regional banks right now. That's the sector play. Inside the Dow, Goldman Sachs is just running away with the game right now with a strength score of 84. Microsoft has had a nice recovery here, green and white. Weakness in Boeing, yellow and white, and weakness also in Intel and Chevron, being red and yellow in the strength and consistency relatively. But again, the top 5: Goldman, Morgan, Disney, Nike, United Health, and you can just see the strength in the financials. Goldman Sachs and J.P. Morgan. That's sort of the default posture to go to. On days where we see the market doing well, financials doing better, and then Goldman and Morgan leading the way, that's the lowest risk trade that there is for that one day. So we're going to look. We're going to add J.P. Morgan and Goldman to our relative strength list for looking at charts. Shifting to the daily report now, no signals in channeling or overreaction. In the big indexes, we have XLB as channeling and overreaction in the sectors. Microsoft on channeling, I like that one, since it was a relative strength leader. And Pfizer in healthcare, PFE. Take a look at those. We'll look at Cisco and Coke for the 5 days down, as well as XLB. I'm going to look also at, from the auto framers, look at some of my usual suspects like Cliffs, DuPont, and Monsanto. We'll look at treasuries too. That'll give us enough. Monsanto and treasuries. Okay. Again, you can see quite a few 5DDs, lots of frog numbers in excess of 3. We've got some RSI2 numbers here, Microsoft and DuPont, ExxonMobil, Procter & Gamble and Cisco, Intel, and Coca-Cola. All had favorable numbers on the RSI2. So they're going to be well postured. Inside the ETFs, the same kind of feeling here. We've got more than half of them on a frog quality number greater than 3. We've got XLB has a RSI2 value of 5. It's a 3.8 frog. It's got an 11-cent SD. And it's a 5-day down, channeling and overreaction. So that means to me I got to be on the lookout for the XLB basic materials, and then Alcoa, Cliff, and DuPont triangle, if you will. I like Latin America as a 3.3 frog quality number. It was one of the big winners on Friday, along with Brazil. So I'm watching Brazil here with a 21-cent frog standard deviation, and was a big winner. It was the big winner among the ETFs on Friday. So I'm looking for some continuation in Brazil. Lots of signals to choose from on the auto framer. See some of the ones we're going to look at, like DuPont, Honeywell, Cliff, Monsanto, Treasuries, real estate are all on there, ExxonMobil. On the regression line fractals, the big value plays, Walmart. Now I like Alcoa on this list. It's technically not part of the Dow, but I usually just keep it in that stack because I've traded it for so long. So Alcoa and DuPont are both on that list. Caterpillar is one of the relative strength leaders because it's 7 ATRs above its 270 regression line. So we're gonna look at Caterpillar as well. This is our new chart of goodness here for sourcing interesting one-day trades using that Z3 strategy. We're still busy processing the videos from the last workshop. I'll let you know as soon as we have that thing ready to ship. but you'll be able to see the birth of the Z3 pinch breakout. And so what we're looking for, essentially, we're looking first for targets that have become compressed on a daily basis. Right, so that means that the range is less than 0.7 of the average. So that's this column. Everything in this column is less than 0.7. So that tells you these were all compressed on Friday. Okay. The second thing we're looking at is a large potential intraday move compared to the size of the range. So we're going to compare the range stat, which is this number, and we're going to divide that by the risk that we have chosen, the my risk, and we come up with this ratio. So these have to be better than 2. So what that says is the combination of these factors shows something that was relatively compressed on the previous day, and the size of its maximum normal move, the range stat, compared to how much risk that we think we can take mechanically, which is the range risk, still is favorable. So if we do get a breakout above Friday's high, then that's the kind of day that could lead to a range stat move, and that's why we want to look at these candidates. So things that stick out to me: United Health, Oracle, Boeing, Honeywell, Freeport Morgan in the commodity space. So all of these look to be pretty interesting. All right, so that's enough symbols and signals to prepare. What I'm going to do now is shift to looking at charts of interest. And we're going to just start off, we'll just go right from the top. Let me get the, let's see here, stand by. So I'm just going to go quickly down the list of the symbols that I announced that got my attention. And so we're just going to look at daily charts here. So what we have is you can see is a Z3 pinch breakout on the daily, and I like the looks of this. It's digested those gains pretty well, and I'm ready to buy a breakout to the upside. That looks straightforward. Next up, HAS. Hasbro. This looks to me, yeah, sorry, FedEx, thanks. This to me looks like more of a opportunity to get short on weakness. I'm thinking this is headed back more towards here. What I'd be looking at though is over the next couple of days, can Hasbro find support north of the dragon? So we're going to look. Here's the top of the dragon, the spine of the dragon, the bottom of the dragon, and then the Bollinger Band mean. Any one of those spots that hold support and we get a universal entry looks to me like a place you can get long on Hasbro, because what we have here is a Z3 pinch, and you can see the breakout from this level here, and then 6 or 7 days of steady pressure, buying pressure. And so these look to me like natural places for it to find support. So that would be the way I would play it. It's not until it gets below the Bollinger Band mean that we have something like a rejection of this primary move. So I would be looking for ways to find ways to get long Hasbro north of 70, looks like 74. So I like Hasbro. All right, let's look at Aetna. This one looks pretty hard to trade to me, although the numbers speak well. It's pulled back to the edge of the dragon, but that looks very hard to trade to me. I don't think I could trade it. We'll look at Lilly. When I mean too hard to trade, I don't see orderly price movement. I love Lilly right here. What I'm looking at is this kind of a trade frame. Yeah, I'll buy a breakout above 86.40 with a basically about $1.50 of mechanical risk. I also think that's one that can be traded intraday. We've had good success on this. You can see a previous Z3 on a daily back here from 74. Now it's up to 86. So this is one that's been working pretty well. This whole move inside here, if I could expand, this was during the period of the live trading workshop in the highlighted yellow box, and that proved to be very lucrative. And it seems to have found its support level above 82. So had a nice close on Friday and an inside day and some range compression that looks very nice, poised and ready to go. So I really like Lilly here. We'll look at Humana, also in the healthcare. We traded a lot of Humana back during the workshop as well. It seems to have found support now north of 184. I would prefer Lilly to this one. This still feels like it's come all the way back to its fair value. I just want you to notice here the usefulness of the 270 regression line. That's this purple pinkish looking line. We consider that to be the fair value. Now it's been going up, but that first big spike out of the Z3, and then it hasn't been able to follow through. It has now come back 14 days later back to the 270 regression line, which really said that of that whole move, there was probably about $4 to $6 worth of value in that. That's how much higher the 270 has gone. But it's found support at the 270, and so I think there's a possibility for this kind of a move to come back up into this value zone. So I'm not giving up on Humana. I will compare that one to Lilly on an intraday basis to see which one is moving. We'll look at DuPont now. This is a Z3 pattern, and I'm ready to go long on a breakout to the upside if it comes back to Z -2, and I'm ready to go short if it goes below Friday's low. And then how far can DuPont go? It can go a long way down. On the downside, it can come all the way back to the support level of 63. And if it violates there, look out below. On the upside, just getting back to 70 and the Bollinger Band mean is a good trade. So DuPont looks like it's in play. This is part of that whole collapse inside the commodities and basic materials. And so that puts it in a critical state. Let's look at Alcoa while we're here. Alcoa is in the same condition as you can see. When we zoom in, yeah, I'll go short any new low, and I'll go long on a new daily high, and just play this as the swing with an initial target of about 12 and a quarter, ultimately looking at 13 and a quarter for fair value. But there was a lot of volume traded here around between 12 and 11.50, and we've had 2 days in a row without a new low, and we had a favorable price action on Friday and held it over the weekend. So I'm looking to be an Alcoa trader. I'll start tactically, and what I will try to do is make some money in Alcoa on the long side if it's going up, and use that to leave a piece to hold a core swing position. So I'll let the day trading activity fund the swing position on Alcoa. So I like Alcoa. We're probably going to see about the same pattern in Cliff, CLF. Yep. That also had an up day on Friday, and came down and flirted with Z -3. This is the trade frame I'm looking at. When it has all these excess lines, that just tells you I've been trading a lot of it. I use these as little trade frame builders intraday and on swing patterns. So I'm looking for it to get back to 520. Sorry. So on this trade frame, what I'm looking at is to get long about 470 with about a 30-cent stop. My target on the upside is 520, but if I get a violation to the downside, if I can borrow shares in it, I would be short. But I'm feeling the long side of this more. This is a Z -3 trade to the downside. Let's look at Monsanto. Also in healthcare. This is the opposite of Lilly and Humana. This is one where we get any kind of weakness, we can get short this again. It's already at 2-month lows, and you can see this is really collapsing. It already violated the lows of last year. On the other hand, you can see that what we also have is this regression line fractal framework. And so what we'd be looking at there is we're looking at the difference between the 10 period and the 270. That's the opportunity zone inside this rectangle. If I can draw that real quick. That's how much difference of opinion there is between the fair value as voted on by traders, represented by the 10 period, and then the long-term holders, represented by the 270. So that's the difference of opinion. So when I look at this, I'm prepared to take the following trade, and that is just buy a new mechanical entry simply on a trade location basis. And this is the day I'll start stalking it here. So that's my trade frame. Let me move this out of the way, the boxes. So now what you can see is I'm ready to get long at 108.50 with the target of 117, with a couple bucks, maybe $3 as mechanical risk on a swing. And I'm where I would be looking for resistance would be at the edge of the dragon, the north end of the dragon. If it gets through the dragon through 112, then this should go all the way back to the Bollinger Band mean, and then all the way up to the long-term fair value. So this one is set up strictly by the difference in opinion between the 10 period and the 270 period regression line. That's what we mean by that divergence. Yeah, that's fine, Robert. Monsanto is chemicals and more like XLB and DD. That would help explain its weakness. No worries. Let's see. Let's take a look at one that was a relative strength leader, Caterpillar, also in that materials, industrials area. Monsanto was weak and Caterpillar was strong. When we look back far enough, we can see that that's the opposite of the of what had been the case for materials like if you remember, DuPont, Monsanto, and Alcoa were all in that long slide. This has actually put in a pretty nice leg of a move up from in the month of May and June, about a 6 weeks period in which it's gone from the support level at about 80 up here to about 86. Now inside that little recovery, we've had this positive move. Now what I want you to notice here is we now have the positive divergence between the 10 and the 270, and this is what one of those regression line fractals looks like, but to the upside. We saw what it looked like in Monsanto to the downside. This is the yellow box shows the divergence between the 10 and the 270, and now this yellow box actually represents 7 ATRs of Caterpillar. So just on a trade location basis, what you could say is, look, if if I was going to go short, I could give this if it failed $2, I could get short and say it's going to go back to the 270. So anything less than a $2 stop here would be in the noise level. So if I want to bet on relative strength, let me clean some of this out. Let's see what this trade frame looks like. I think it's going to be pretty good. It actually had a really nice rebound and recovery move on Friday after flirting with disaster. So I'm ready to buy this on a continuation basis. And this would be my trade frame to the upside. Getting long around 87. I'd go up and test around 89. But I would also be willing to go short this at 85.80, and my target would be down here at the swing low around 85. So that's my trade frame there. I like this in both directions. It's perfectly postured at the bottom of the river, so we can go long and believe that we're buying value on sale. I also like that the Bollinger Bands have pinched a little bit here, and so this price action in this horizontal river is stabilized around, say, fair value about 87.5. So we can get long at 87 and be buying on the correct side of value inside of the channel. So that looks pretty favorable to me. I want to shift real quickly here, a few minutes remaining, to look at some of the real leaders. Let's look at Goldman, which was the strongest symbol in the Dow. This is what that uber strength looks like. Hard to argue with that chart. I like the 3-day pullback here to 213 that's found support at the edge of the river. I'm ready to buy a continuation of strength on that one. Let's look at JP Morgan. JP Morgan shows the same kind of chart pattern. Large cap banks. That one's even easier to believe in because the price pullback has been so orderly. That's an easy one to get back on. We would look at FAS. On a day when the market is moving up and the financials are doing better, you should look at JP Morgan and Goldman and compare it to FAS and see which one's moving stronger, and buy that one. Let's look at the tactical trade frame on XLB. Sweet. So what we have here is the material sector is below its long-term fair value. It just crossed, and so what that says is here's a special application of that RLFF. So I'm going to go back to where there was a maximum divergence between the RL10 and the RL270 to the upside. That's that yellow box. So since that time, prices come back to the zero line, back to 270, and now it's gone below. We say, how far south can this go? It can go as far to the south side as it did to the north side. So we can now put, using just symmetry here, we can put a tactical target down here around 48.50 and say, now if we get a price failure below 49.25, we can get short. With an initial target of 48.50, and then your initial stop. We said an XLB was like 11 cents because of the frog box. So this one, if we used a full range risk, that would be like a 50 cent. So if we looked deeper inside this, we would see that XLB looks pretty directional, and so if we got some weakness, we could be a lot closer than 50 cents away. But even on a mechanical basis, this is starting to look attractive. So we have a prime target in both directions. Let's just take a quick look at the hourly charts on this rascal and just see how orderly this move is. So now you can see the distance from the 270 to the downside, around 48.60 still. So any failure below, so this is a case where I'm perfectly happy to get short at 49.30, and in this case, I could use a 20-cent stop without much concern. So now that looks like a really attractive intraday trade. Okay, so that's everything I want to cover today. We've got a organizational meeting here in about 10 or 15 minutes with our assistant coaches as we develop that program for the year ahead. So I need to take a break, and we'll get this one processed and hung on the website. And thank you for your support and interest, and we'll see you in the chat room. If you have not been in the chat room the last couple of weeks, you really owe yourself a service by getting there and reviewing the awesome work that Jeff and Sonal and Joey and James and Patrick are doing in there. There's just some incredible trade frames and management techniques being used. These guys are doing an excellent job of putting this work into practice. So hats off to them. Keep up the great work. You're doing a wonderful job in there, guys. So keep up the good work. Anyway, that's everything I have to cover tonight. So thanks for your attention, and we'll see you in the chat room.